What is an index fund? The easiest way to build wealth. Imagine owning shares of India's biggest companies without researching hundreds of stocks. No stock picking, no complicated analysis, no guessing which company will win. That's exactly what an index fund does. Many legendary investors like Warren Buffett have recommended index investing for most people. Today we will learn what an index fund is, how it works, benefits and risks, major index funds available in India, who should invest in them. What is an index fund? An index fund is a mutual fund that simply copies the stock market index. For example, Nifty 50 contains India's top 50 companies, and Nifty 50 index fund buys those same companies in similar proportions. If the index rises 10%, the fund will aim to rise roughly 10%. The goal is not to beat the market, the goal is to match the market. Why were index funds created? Many professional fund managers fail to consistently beat the market over long period. Index funds offer low cost, diversification, simplicity, passive investing. Instead of trying to find the next winning stock, you own the entire basket. Example of an index fund. Suppose you invest 10,000 in a Nifty 50 index fund. Your money automatically gets exposure to companies such as Reliance Industries, HDFC Bank, Infosys, ICICI Bank, Tata Consultancy Services. One investment, many companies. Advantages of index fund: low cost. Expense ratios are usually lower than actively managed funds. Diversification: one fund can hold dozens or hundreds of stocks. No stock picking. You don't need to analyze balance sheet every day. Long-term wealth creation. Historically, broad market indices have grown with the economy over time. Beginner friendly. Perfect for people starting their investment journey. Risks of index fund. Index funds are not risk-free. Market risk. If the market falls, your fund falls too. No outperformance. You won't beat the index because you are tracking it. Volatility. Short-term fluctuations can still be significant. Remember, index investing is a long-term strategy. Major categories of index fund in India. Nifty 50 index fund. Track India's top 50 companies. Popular choice include UTI Mutual Fund Nifty 50 index fund, HDFC Mutual Fund Nifty 50 index fund, ICICI Prudential Mutual Fund Nifty 50 index fund, SBI Mutual Fund Nifty 50 index fund, Nippon India Mutual Fund Nifty 50 index fund. Nifty Next 50 index funds include track companies just below the Nifty 50, higher growth potential and higher volatility. Nifty 100 index fund combine Nifty 50 and Next 50, provides broader market exposure. Nifty 500 index fund track 500 companies across large, mid and small caps, one of the broadest market exposures available. Sensex index fund track the 30 companies in the BSE Sensex. Nifty Midcap 150 index fund focuses on medium-sized growing businesses. Nifty Small Cap 250 index fund focuses on smaller companies, higher risk, higher return potential. Sector index funds include Banking Index Fund, IT Index Fund, Pharma Index Fund. These are more concentrated and riskier. Which index fund should beginner choose? For most beginner, option 1, Nifty 50 index fund. Option 2, Nifty 100 index fund. Option 3, Nifty 500 index fund. This provides broad diversification and simple investing. Many investors build wealth using SIP in this fund over decades. Index funds are simple, they are low cost, they require little maintenance, and they allow investors to participate in the growth of India's economy. You don't need to predict the next multi-bagger. Sometimes the smartest strategy is simply owning the market itself. That's why index funds have become one of the most popular investing tools in the world.